They completely smashed consensus. I mean, a 74.7% jump in net income in a single quarter for a heavy industry municipal pipe manufacturer. Usually you only see that kind of pop if a company, just liquidated half its assets.
Right. But NWPX, infrastructure ticker NWPX, they didn't sell off the furniture here.
No, they absolutely did not. They just posted a massive Q2 2026 beat. We're looking at record revenue hitting $159.5 million, which is up 19.7% year over year. And EPS came in at a staggering $1.62 per diluted share. Net income hit $15.8 million. And the kicker, management is guiding that Q3 is going to be comparable to or potentially even stronger than this record-breaking quarter.
Which is exactly why we saw the stock immediately reprice on the news. I mean, those are the kinds of headline numbers that force the market to wake up.
Exactly. But if you're listening to this, you know that the actual story with an industrial cyclical isn't just the top-line beat.
No, not at all.
Our mission for this deep dive is to tear apart the segment data. We need to figure out exactly how a legacy manufacturing company generated the highest net income in its entire history. Well, excluding that one-time acquisition gain back in 2018, of course.
Right. To look under the hood.
Yeah. So if you are holding this stock, or if you're staring at this EPS print wondering if you missed the boat entirely, you need to understand the engine driving this. We're going to unpack the segments, the margins, the cash allocation, and, because we have to, the macro risks lurking in their 10Q.
But before we even touch the P&L, you really have to contextualize these numbers with the broader structural tailwind. I mean, NWPX is not operating in a vacuum here.
Far from it.
They are sitting right in the middle of a $50 billion total addressable market just for U.S. water transmission. We're talking about a North American water and wastewater grid that has been, frankly, severely underinvested in for decades.
Yeah, like failing legacy systems everywhere.
Exactly. You've got municipalities desperately trying to patch up these failing systems.
Yeah.
And simultaneously, you have entirely new population centers springing up across the Sun Belt out west.
Which all need new pipes.
Right. This isn't just routine maintenance. We are in the middle of a generational replacement cycle, and NWPX is positioned directly in the path of all that municipal capital flow.
So let's get into how they're actually capturing that capital. Looking at the Q2 presentation, we have to start with the legacy business, right? The Water Transmission System segment, or WTS.
The cash cow.
Yeah, the heavy-duty side. Large diameter, high-pressure steel pipelines. Break down the profitability metrics here, because honestly, a 33% revenue jump doesn't fully explain how EPS jumped 74%.
No, it doesn't. So WTS net sales were up 33.8% to $113.2 million.
Yeah.
Huge top-line beat. But the metric you really want to watch is gross profit.
Okay.
Gross profit in WTS surged 60.9% to $24.2 million. And their gross margins expanded by a massive 360 basis points. They landed at 21.4% for the quarter.
Oh, wow. So they are getting serious operating leverage out of this volume.
Exactly.
Like, once they cover the fixed overhead of just keeping a massive steel plant running, almost every single incremental dollar from these new orders is just dropping straight to the bottom line.
It is the textbook definition of operational efficiency in heavy manufacturing. You love to see it. And management broke this growth down into two distinct drivers.
Right, price and volume.
Yep. The smaller driver was a 6% increase in the selling price per ton.
Which implies they have some pricing power, or at least a better product mix. Right?
Exactly. It's a favorable product mix. They aren't just selling bulk commodity steel. They are pushing higher value, more complex engineered products through the pipeline.
Okay, but the larger driver, and this is where I have to push back a bit, or at least raise a red flag for you guys listening.
Go for it.
The presentation cites a 26% increase in tons produced. And management explicitly blamed, or I guess credited, this volume jump to project timing.
Yeah.
If I'm an investor, project timing sounds incredibly suspiciously like a one-off fluke. Like, it implies a bunch of contracts just happen to clear the bottleneck, hit the factory floor all at once, and boom, record quarter.
Yeah, it sounds like pulled forward revenue.
Exactly. Are they going to hit a massive air pocket in demand next quarter because they just burned through their backlog way too fast?
It's a completely fair question. Honestly, it's the most common trap when retail investors analyze industrial cyclicals. You see a huge production quarter and assume the pipeline is now empty.
Right.
But you have to counter that fear by looking strictly at the backlog data. So even after operating at max capacity, right? Even after recognizing revenue on thousands of tons of steel in Q2, The WTS backlog still sits at a very healthy $305 million as of June 30th.
Okay, but to be fair, that is down from the $373 million they reported at the end of Q1.
It is down, yes,
Yep.
but mathematically it has to be down given the sheer volume they just pumped out. But here's the thing, $305 million is only part of the picture. In municipal infrastructure, you have to look at the total pipeline. When you include what they call confirmed orders, that total backlog figure jumps up to $423 million.
Okay, wait, let's pause on that mechanism for a second, because that distinction is actually vital if you're analyzing this space. What exactly is a confirmed order versus official backlog?
Yeah, so a confirmed order isn't just some handshake deal or a verbal agreement. It means NWPX won the formal bidding process. The local government has officially selected them as the vendor.
So it's basically guaranteed future revenue?
Pretty much. It just hasn't cleared the final legal red tape, getting the final signatures on the municipal contracts to officially hit the formal backlog metric. But the work is theirs.
Got it. So that $423 million figure basically proves that demand is replenishing the pipeline almost exactly as fast as the factory floor can clear it.
Exactly. Management even noted that robust bidding activity continued through the whole second quarter and went straight into Q3.
Which means they can maintain that high factory utilization, which protects that 360 basis point margin expansion.
Right, while simultaneously stacking new mega projects for the back half of the year and even into 2027.
Okay, well, that context makes their Q3 guidance feel a lot less speculative, honestly. If you have over $400 million in confirmed visibility, saying Q3 will match a record, Q2 isn't just management being optimistic.
No, it's just basic math based on their forward production schedule.
Oh.
WTS is completely firing on all cylinders right now.
But, no earnings report is absolutely flawless.
It's true.
If WTS was the outperformer, we need to talk about what held the overall consolidated top line back from being even higher. And that leads directly to the Precast Infrastructure and Engineered Systems segment.
Yeah, the laggard. And precast operates on a completely different frequency than those massive, lumpy water transmission projects.
Totally different business model.
Right. This segment does reinforce concrete products, lined sanitary sewer systems, automated water control. It's a very localized, highly transactional business.
And it undeniably struggled this quarter. Precast net sales dipped 4.8% down to $46.3 million. And when you isolate just the volume, the tons shipped actually decreased by 11%.
Ouch. Yeah, though that revenue drop was partially shielded by a 7% increase in selling prices, which is good. Again, utilizing pricing power and favorable product mix.
Sure, but an 11% volume drop still hurts. Gross profit dipped 1.7% to $10.1 million. However, and this is interesting, the gross margin in precast actually improved by 70 basis points year over year.
Right. They hit 21.9%.
Yeah. So even with a double-digit volume decline, they operated more profitably on a per-unit basis. But we need to look at why that volume evaporated in the first place.
It wasn't a demand issue.
No, it wasn't.
Yeah.
I look at this segment right now as sort of a coiled spring.
Right.
If you parse management's commentary, this volume drop was entirely a severe logistics and weather issue.
Yeah, the physical realities of heavy construction.
Yeah.
You literally cannot pour foundations, excavate trenches, or lay heavy concrete when a job site is underwater.
Right. Management pointed out there was unusually heavy, sustained rainfall in Texas that basically paralyzed job sites through all of April and May.
And they had customer-driven project delays in Utah at the exact same time.
Exactly. So for like 2/3 of the quarter, the precast segment was fighting with one hand tied behind its back. They physically couldn't deliver the products.
But think of it like a major highway during a torrential storm, right? The cars don't just cease to exist.
Right, they just pull over and wait.
Exactly. The demand didn't vanish. It just shifted to the right on the calendar. And the moment the skies cleared in June, all that pent-up logistical traffic hit the road. They saw a massive bounce back in shipping volume right at the end of the quarter.
Which is why you can't let a short-term weather blip mask their long-term M&A strategy here. Precast is not an afterthought for NWPX.
Oh, not at all. It is their primary engineered growth vehicle.
Right. The stated corporate goal is for this precast segment to eventually match the legacy WTS business in size, which is a massive mandate for a company historically known for steel pipes.
And they are executing it through really targeted acquisitions. Like in 2021, they bought Park USA for $90.2 million.
Which was a very calculated move to dominate the Texas market, right?
Yeah, Texas. And to acquire advanced water control technologies. And you have to understand the logistics of concrete to see why these specific regional buyouts matter.
Concrete is heavy.
Incredibly heavy and super expensive to transport. Precast is essentially a localized monopoly business.
Right. You can't profitably manufacture a concrete sewer system in, say, Ohio and put it on a flatbed to Arizona. The freight costs would completely destroy your margin.
Exactly. Which is why their recent February 2026 acquisition of Botten Precast is so brilliant. You buy a precast company to acquire its geographic radius.
And Botten gives them immediate penetration into the Colorado Springs market, which is booming.
Right. They are taking their legacy footprint and systematically bolting on these high-margin precast operations, specifically in the Sunbelt and Western regions that are seeing massive population growth.
And the ultimate proof that the underlying demand is still there, despite the Texas floods, is sitting right in their order book. They closed the quarter with a $61 million precast order book going into the second half.
So the runway is totally clear for a huge bounce back in Q3 and Q4.
Absolutely. And this whole dynamic creates a really fascinating capital setup for the company. You've got WTS generating massive scale and acting as this high-margin cash engine.
And then management is siphoning those profits to fund the M&A geographic expansion on the precast side.
Right. So since we're tracking how they fund these acquisitions, let's actually look at the bank account because earnings are an accounting metric, but cash flow is reality.
Cash is king.
Exactly. Are they taking on dangerous amounts of debt to buy these companies? Let's talk capital allocation and the balance sheet.
The cash generation is honestly formidable. Operating cash flow skyrocketed to $14.1 million in Q2. Just to put that in perspective, they only generated $5.4 million in Q2 of last year.
That's a huge jump. And looking at the balance sheet, it is absolutely bulletproof. As of June 30th, they have zero outstanding revolving debt.
Which is incredibly rare right now.
Totally. In a macro environment where industrial companies are seeing margins just obliterated by interest expenses on variable rate debt, NWPX has a clean slate and about $124 million in available borrowing capacity.
Having a pristine balance sheet in a high interest rate environment is a massive strategic moat. It means when they find the next Botten or Park USA to acquire, they don't have to scramble for expensive financing. They have the dry powder ready to go.
And it gives them the flexibility to aggressively return capital to shareholders, which they are doing.
Yep.
They repurchased about 35,000 shares for $2.5 million in the first half of the year.
And they still have, what, $13.9 million authorized?
Yep. $13.9 million left on the plan. And buying back stock while sitting on zero revolving debt is basically the clearest signal management can send that they think the stock is undervalued. But, and I want to pivot here, there is a specific metric in this presentation that I guarantee most retail investors completely ignore, but it actually explains exactly how they achieved that 360 basis point margin expansion in WTS.
Oh, you're talking about the ESG data, the safety record?
Yes. The total recordable incident rate, or TRIR, they reported a 2025 TRIR of 1.06, which management noted is way below industry averages.
Right, and usually safety metrics are just corporate filler, right? Just fluff for an earnings deck.
Right, but in heavy manufacturing, safety is the direct precursor to operational efficiency. Think about the physical reality of a steel pipe factory. You have overhead cranes moving multi-ton steel cylinders.
Yeah, it's intense. And if there's a safety incident like a load slips or someone gets hurt, production doesn't just pause for a 5-minute coffee break.
No, the entire line shuts down. You trigger mandatory safety investigations, regulatory site visits, equipment recalibration. Shipments get delayed.
And in a business model that entirely relies on maximizing factory utilization to absorb fixed overhead, an interrupted line instantly crushes your...
Exactly. Management constantly preaches margin over volume. You literally cannot achieve a 360 basis point margin expansion if your factory floor is chaotic. A 1.06 TRIR proves their lean manufacturing process is actually functioning in reality, not just on a spreadsheet.
It's a really solid point.
Okay, so we've built a pretty solid bull case here. Pristine balance sheet, record margins, $423 million confirmed backlog, humming production lines. But we have to look for the cracks.
Always.
When you dig into the 10Q risk factors, what are the actual macroeconomic threats that could derail this? What breaks the NWPX thesis?
Well, you have to monitor 3 specific structural risks. The first is raw material price fluctuation.
Steel and cement.
Exactly. They consume astronomical quantities of both.
Yeah.
Now, they've benefited from favorable pricing recently, but these are global commodities. Any geopolitical shock or supply chain issue that spikes the cost of raw steel will immediately compress those margins.
Because that
Exactly. If steel doubles between the time they win the bid and the time they actually manufacture the pipe, NWPX absorbs that loss. You can't just pass a sudden cost spike back to a city council that already approved a strict budget.
That's a huge point. What's the second risk?
Execution risk on the M&A strategy. Scaling precast through acquisitions looks brilliant right now, but integrating companies like Park USA involves merging complex software systems, aligning distinct corporate cultures, cross-training.
The press release is always the easiest part of an acquisition.
Exactly. If they hit integration bottlenecks, the precast segment could stall out, leaving them overly reliant on the legacy steel business again.
Makes sense. And the third risk?
The third, and honestly arguably the most systemic, is macroeconomic interest rate risk.
But wait, we just said they have zero revolving debt?
They do, which insulates them from direct interest expense. However, their end customers are entirely exposed.
Oh.
Think about the precast segment. A lot of that demand comes from commercial construction, housing developments, local municipalities. All of them rely on financing. If macro interest rates stay elevated or climb, project financing freezes.
Right. A developer realizes the cost of capital is too high, they cancel a new subdivision in Colorado, and suddenly the demand for NWPX's automated water systems just vanishes.
Exactly. And that dynamic sets up the ultimate concern regarding their primary customer base.
The presentation highlights this crazy data point. State and local governments fund 96% of all public water investment in the U.S.
96%. The reliance on municipal spending is total. State revolving funds and local tax bases are the absolute lifeblood here.
Okay, let's bring all of this together. What is the rapid-fire synthesis for the investor analyzing this record Q2 print?
The synthesis is that this is a masterclass in capital allocation for an industrial cyclical. NWPX is leveraging its legacy WTS segment as a highly efficient, high-margin cash engine. They're taking those record operating cash flows and aggressively scaling their localized precast segment through targeted acquisitions in high-growth Sunbelt geographies. And they're doing all of this while maintaining a bulletproof balance sheet with zero debt and actively buying back their own stock.
It is undeniably a textbook operational quarter. But before we wrap this deep dive, I want to leave you guys with a final lingering question to chew on, building directly on that municipal risk factor we just talked about.
Yeah, this is the big one.
We know state and local governments fund 96% of public water investment, but right now we are watching macroeconomic inflation severely squeeze municipal budgets across the country. Everything costs more, from teacher salaries and pensions to basic road repairs.
It's real crunch.
So, as an investor, you have to ask yourself, how insulated is NWPX from local funding freezes at the municipal level? Even with billions of dollars in federal infrastructure bills theoretically sloshing around in Washington, if a local town council literally cannot balance its basic operating budget, will those massive confirmed backlogs actually convert to cash on the factory floor? Or will they just get delayed indefinitely?
Yeah, monitoring how efficiently those federal dollars actually filter down to the local project level is probably the single most important macro dynamic for any infrastructure investor right now.
Absolutely. It is the ultimate tension between federal promises and harsh local realities. And we will be tracking exactly how those backlogs convert right here. If you want to stay ahead of the market and truly understand the mechanics behind the headline numbers, make sure to follow the show for your daily, no-fluff earnings coverage. We read the 10Qs so you don't have to. Catch you on the next deep dive.